Aaron Layman Properties here with your North Texas housing market update. The housing market is now in full-blown correction mode. The Fed Reserve's housing market reset message is finally sinking in. Home sales volumes continue to slide. Home prices in the Dallas-Fort Worth area continue to drop from their blow-off peaks earlier this year. Mortgage interest rates have spiked to 7% while the Fed puts the balance sheet roll-off into high gear. The Bureau of Labor Statistics reported consumer price inflation for September at 8.2%. That was higher than analysts expected. CPI for core inflation was also higher. The updated 12-month change for shelter inflation looked like this. Shelter was up 6.6%, rent of primary residence was up 7.2%, and owner's equivalent rent was up 6.7%. The CPI's measures for housing inflation are still on the rise, and shelter inflation is the highest we've seen in decades. Not surprisingly, bond yields spiked higher on the news, and mortgage rates also moved higher. Market participants are finally beginning to see the recklessness of letting inflation rip higher while the Fed pretended it was all just transitory pandemic-related noise. Almost every large real estate and mortgage firm that does price forecasts is now projecting home prices to fall next year. Mortgage giant Fannie Mae was the latest to revise their U.S. home price projections downward. Fannie is now calling for home prices to fall 1.5% in 2023. The correction in real estate has been caused by many of the large asset owners, particularly those in the private equity space and consultants who serve them, to lose their minds. Cries for a Fed pivot continue to grow as inflated home prices and rents begin to mean revert. It has been particularly amusing to see some of the professional economists try to run cover for their employers, or more specifically their employers' clients, attempting to distract the public from blatantly inflated home prices and rents. There are apparently a lot of crony capitalists in the real estate industry. Not exactly shocking. They loved the cheap liquidity when prices were ripping to the moon. Now that the Fed is draining the same liquidity from the financial system, real estate speculators and rentiers can't get their bailout fast enough. For some context on just how absurd things became during the field of economics, Ben Bernanke has just been awarded a Nobel Prize. Yes, that Ben Bernanke. You can't make this stuff up. Back in the land of reality where economists like Ben spent the last 14 years helping to turn the U.S. housing market into a warped, flipped, speculative mess, another housing bubble is deflating. This everything bubble isn't exactly like the last housing bubble that blew up in Ben's face, but it shares some similarities. The outsized investor and speculative activity have been particularly noticeable coming out of the pandemic. A recent survey showed Dallas, Texas is the top market in the country for home flippers. Roughly 12% of the resale volume in the past 12 months has been flippers. There is still way too much activity from investors, Airbnbers, and build-to-rent private equity parasites in the housing space. That infection spurred by years of cheap liquidity is going to be difficult for the Fed to remove. Some of these investors are now getting their heads handed to them by the Fed's reset. Real estate prices have begun to cool rather quickly, and many investors are exiting the market. This is why we're seeing prices fall, even without a dramatic rise in inventory levels. Available homes for sale are still below pre-pandemic levels, but prices are falling anyway. This blows a giant hole in the narrative floated by many real estate agents and other clueless sell-side pundits who pretended the DFW housing boom was simply supply and demand driven by organic growth. To put things into perspective on just how crazy the DFW bubble grew during the pandemic, I've put together some 10-year charts showing both new and resale home prices. This provides some context in terms of the supply and demand distortions. New home prices have been trending lower for several years prior to the pandemic. The pandemic boom was a boon to North Texas home builders, and they squeezed buyers like never before. As inventory evaporated, builders and existing sellers ramped prices to the moon, taking advantage of what was probably a once-in-a-lifetime opportunity to exert pricing leverage. It helps to remember that prices are formed at the margins. Liquidity provided the fuel on the way up, and it is becoming a drag on the way down. That pricing leverage is fading now that inventory is finally coming back to the market. The housing correction varies across the DFW area. The price declines in Denton County have been pretty clear, though. Median home prices in Denton County are still up 11.6% from a year ago, but they have fallen $55,000 from the May 22 peak. Average home prices in Denton County have fallen $77,000 from the May blow-off top. Average prices are only up 6.7% year over year. They could easily turn negative if the Fed keeps tightening the screws. Inventory has begun to climb again after a brief dip at the end of the summer. Now that mortgage interest rates are up to fresh highs for the year, demand has been crushed. New listings in Denton County are up about 14% from last year, but the absolute number of homes for sale has been relatively stable for the past few months at roughly 3,200 homes. As demand gets crushed even further, months of inventory has grown. Days on market have jumped significantly in the past few months, approaching 3 weeks on the median sale. That's still far below historical trend, but you can see the correction taking shape. Percent of original list price has fallen below 100%. It's hard to believe that FOMO activity early in the year drove the average percent of list to 107.2%. It's now back to 96.6% in Denton County. That puts it more in line with historical trend. Families are finally getting more opportunities to purchase more affordable homes as prices come down. The flip side is that mortgage rates are sharply higher, putting a damper on overall affordability, especially if buyers don't have a significant down payment. It should be readily apparent at this point that the Fed's wealth effect is really just a backdoor stimulus for boomers and existing asset owners. The Fed specializes in trickle-down economics and fiscal policy. Prospective home buyers and sellers are slowly waking up to reality. Some sellers are being dragged kicking and screaming. Many buyers are patiently waiting for the Fed to do what they should have done over a year ago. Better late than never, I suppose. U.S. mortgage interest rates are hitting fresh highs and as the Fed works to tame embedded inflation. Higher for longer is still the theme for now. That will continue to weigh on the housing market. I would add that the Federal Reserve has a long way to go on that balance sheet normalization process. The Fed has only begun the process of correcting the monetary insanity that took place during the pandemic. With liquidity being drained at such a brisk pace, market volatility has marched higher, with the stock market actually touching new lows for the year. Paper wealth has a funny way of disappearing when the true cost of capital enters the room. Many agents spent the last 2 years hyping low inventory levels and pent-up demand, confusing unprecedented and unsustainable liquidity with organic growth. 2022 is apparently a year that those clueless loan officers and real estate agents received their crash course in market fundamentals. That's it for now. If you are in the market to buy or sell a North Texas home, be sure to give me a call. I may not tell you what you want to hear, but I will treat you with the honesty and respect that you deserve. Thanks for tuning in.